Well, first of all, I wanted to thank Chairman Tsai and then the Cathay team for inviting us to be here today. We really appreciate the opportunity to be here, and we are thankful for the partnership with Cathay, and we're so honored to be featured at the forum today. My name is Justin Tang, and I'm responsible for PIMCO's business in Taiwan. PIMCO, for those of you who are less familiar with our firm, PIMCO is actually one of the world's most premier and largest fixed income manager. We also specialize in private credit. For more than 50 years, we have helped our client to navigate different market environments, and as of today, we manage about $2 trillion of assets on behalf of our clients. We also have our economic forums, similar to today, and this is at our heart of our investment process. We also invite outside speakers, including a PIMCO Global Advisory Board chaired by Dr. Ben Bernanke. And today, it is our great honor to invite my esteemed colleague, Dr. Richard Clarida, to come to Taiwan, who is also, like Catherine mentioned, a former vice chair for the Fed. We recently also concluded our secular forum, so today we'll invite Rich to share his insights and takeaways from that discussion. To set the stage for Rich, I'll just by saying a few things, by acknowledging just how much the market has changed over the past year or so. If you remember, 2023 was defined by three things: stubbornly high inflation, Fed hiking rates, and then pause in July, and obviously the US regional banking crisis. And fast forward to 2024, year to date, it is driven by three things as well. We start to see inflation coming down, and we're starting to see debates on when Fed will cut rates for the first time. We'll talk about that in a little bit. And obviously, the coming US election as well. With that backdrop, Rich, let's jump into the fireside chat today.
Looking forward to it.
Okay, all right, Rich. Let me start with a warm-up question, a soft question. If you remember exactly 1 year ago, you were here in Taipei, and we're doing this forum with Cathay United Bank. So now you're back again, and I know you'll visit some other cities as well. So what's your favorite part of being here in Taiwan, in Taipei?
Well, I have to say that in my position at PIMCO as a global economic advisor, I travel around the world. I do a lot of events, but this event last year was really very, very special, and so I was eager to be invited back, and I was thrilled that we're here again. And I had not even realized that my good friend of many years, Tim Geithner, was leading the bill. He's a tough act to follow. But I look forward to the conversation, Justin.
Great, thank you, Rich. And now let's jump into our outlook. So you and our CIO, Dan Ivison, just recently published our secular outlook, which we title Yield Advantage. So can you share with us what are some of the key themes, and what about some of the disruptors to that view?
So Justin, you set the stage well. A lot has happened in the last 12, 14 months, but just focusing on inflation and monetary policy and rates, it was not at all clear 12 months ago. Three things were unclear 12 months ago. Would central banks, including the Fed, succeed in getting inflation back down to the 2% target? Second, if they did succeed, how high would they have to jack up interest rates to do that? And then third, what would be the collateral damage from jacking up rates? As you mentioned, and I think it came up in Tim's segment, we had bank collapses with SVB and Globally Credit Suisse around that time. And so a year ago, our view was that ultimately the Fed and other central banks would get inflation to 2, but it was really unclear how long it would take, how high rates would go, and what collateral damage would be. So at this year's forum in May, the landscape looks a lot different and in some ways much more constructive. Central banks have succeeded in getting inflation down close to target. They paused, and it looks like they finished raising rates about a year ago. Indeed, some prominent central banks, including the ECB and the Swiss, have begun to cut. In the U.S., not only was there not collateral damage to the real economy, the U.S. economy boomed last year with growth well above trend, unemployment rate at a 50-year low. And so a lot of what looked to us a year ago to be macroeconomic and policy risk for monetary policy is a much better balanced outlook on that dimension, but some of the risks we think have migrated over into other parts of the financial markets. So we think the global outlook, average growth for the next 5 years is not going to be exciting, but the risks are better balanced than they were a year ago. Now, there are some positive things, as I mentioned, to say about monetary policy and disinflation. Regrettably, there isn't a lot of positive things I can mention about fiscal policy. The U.S., but many advanced economies piled on a lot of debt, initially in 2008, the GFC, and then doubled down with budget deficits and debt in the pandemic collapse. And so as a consequence, we are in a world where there's much less available fiscal space, and the ability of financial markets to absorb and roll over government debt is a potentially large disruption. On the positive side of the ledger, innovations in AI are incredibly exciting. We spent a lot of time at Forum, and that's a very positive potential development as well.
Great, great. Thank you, Rich. And let's zoom in a little bit into some of that more near-term outlook and implications. Obviously, you mentioned a little bit in your earlier comments. So when you think about U.S. economy, right, for the rest of the year, obviously growth and employment continues to be strong, and inflation has been coming down. What should we expect? What should investors expect for the rest of the year?
Well, growth has downshifted this year, and actually the Fed is welcoming that, because the economy, quite frankly, was running hot last year, running above trend with a historically low unemployment rate. And so the Fed is actually not unhappy that growth is downshifted somewhere to around 1.5%. So far, the rise in the unemployment rate we've seen from 3.4 to 4.1 is more or less in line with what the Fed has been expecting. However, I think we are getting to a point, as the chair emphasized in his testimony this week in Washington, when the Fed is increasingly focused on trying to achieve, that very desirable soft landing. Concretely, what that means is the Fed, I think, is poised to cut rates either if the inflation data continues as they expect, or if the economy were to slow from here and the unemployment rate were to rise. And so this is a committee that thinks that they've done enough, that rates are restrictive, that they're on the cusp of normalizing rates. And so, clearly we came into the year and we came into this week thinking the Fed would cut. We also thought it would be data dependent. I will say that if you're Jay Powell, Christmas came early this year in terms of macro data. The payroll employment report we got exactly a week ago was very Fed friendly. It showed increase in the labor force, deceleration in wage inflation, and then we got a very, very, very Fed-friendly inflation report yesterday, and certainly we at PIMCO expect the Fed to cut, and now our baseline is that the Fed will cut twice. It's not a done deal. One thing I'll say about my good friend Jay Powell is he's a man who likes to keep his options, and so Jay doesn't have to make a decision at the meeting in 2 weeks, but I think the Fed is on a path to get in a couple of rate cuts in the fall.
You spoke about data dependent, Rich, yeah. And I wanted to ask you this question for a long time. And not every day we get to sit next to the former vice chair. So having been in those the decision meetings, right? So and talking about data dependent, when do you think that will be the first cut? Given everything you kind of spoke about earlier.
As I said, I think they are very data dependent, so much so that before I saw that CPI number that was released in the U.S. On Thursday, I had thought that September was still uncertain, but that number was sufficiently Fed-friendly in the context of what the chair was saying before he saw that number. I do now expect that it is likely that we do get a cut in September, and then another cut by year end.
Great, thank you, Rich. And you know, we spoke a little bit about the Fed, and what about some other central banks outside of the U.S.? We've now seen ECB and other, you know, are cutting rates already. Will others soon follow? And from your experience at the Fed, how much do global central banks really coordinate or not?
You know, it's a fascinating question because I was a student of the Fed. Literally, I was a professor and continue to be a professor of economics at Columbia University. There's a very evident empirical regularity if you look at central banks in the last 50 years. We tend to go through periods of global rate hiking and easing cycles. And so clearly there's some correlation in the data. And one thing I always wondered before I was in the room where it happens was what was causing that correlation. And I'm convinced more so than I was even before I joined the Fed that what we do tend to see and what we're seeing now is policy correlation, but not explicit policy coordination. The reason why central banks are cutting is because 2 years ago they were all hiking. Why were they all hiking 2 years ago? They were hiking because inflation was too darn high. Inflation was too darn high for obvious reasons, the pandemic, the reopening, Russia invasion of Ukraine, and all the rest. And so central banks then hiked more or less in tandem. Some central banks hiked earlier than others. I should mention I'm among friends here, as the record will show. I was vice chair from 2018 to 2022, and I was a charter member of Team Transitory. I was, at the time, that actually didn't seem like a particularly controversial thing to say. In retrospect, it didn't look like a great call. I'll leave it up to historians to determine whether or not, if inflation comes down 3 years after you say it's transitory, if it still can be called transitory, but be that as it may. One thing that I did observe, Justin, is global central bankers do see each other quite a bit, and not over Zoom, in person. So the BIS in Basel organizes 5 in-person meetings a year where central bankers from around the world gather. They see each other at the IMF and World Bank meetings in Washington. They see each other at Jackson Hole. And so there's a lot of comparing notes. There's not explicit coordination or horse trading, as in, you know, Christine, if you cut rates, Jay will cut rates. I mean, in my observation, that didn't happen. There are a couple of well-known examples. For example, in October of 2008, after the collapse of Lehman Brothers, the Fed and Treasury did coordinate at a simultaneous rate cut in October of 2008. So it can happen, but it's not the norm. And so, but what we do observe is we observe cycles that are correlated because there tend to be correlated waves in the business cycle and inflation.
Very insightful comments. Thank you, Rich, for that. Also, I think on top of people's mind is the coming U.S. election. And
we have an election in the U.S.? I didn't remember that. Okay.
Yes, that's not until a few months later. So it will be another, as we know, it will be another very close contest between Trump and Biden. So what should investors be watching between now and November?
Well, I do think at this point one would have to first be watching that it may be Trump versus someone other than Trump. That's what the betting markets, but anyway, Republican versus Democrat for sure. Well, I think obviously this is something we pay a lot of attention to at PIMCO. We have a whole team led by the dynamic Libby Cantrell, who writes regularly on this and follows it. What might be of interest to this audience is that along some relevant dimensions, in particular with regards to the outlook for U.S. budget deficits, the outlook looks terrible regardless of who wins the White House. And that's simply because, and I learned this the hard way in D.C., there are very few things in Washington, D.C. That politicians agree on. One is that the U.S. is on an unsustainable fiscal path. The second thing they agree on is that nobody wants to do anything about it. So one of our calls is, regardless of the outcome of the election, we're going to see historically unprecedented budget deficits, as Tim mentioned in his segment, that we've not seen except in wartime for the next 5 years. Indeed, under current law, that is, if Congress and the president can't agree on anything, so what we call the kick the can down the road scenario, deficits run 5% of GDP for the next five years. Now, the election will be consequential economically in the fact that there will be, the Biden folks would be more committed to the green transition. The Trump policy would be focused on a different set of trade policies, perhaps, than the Biden administration. Maybe talk a little bit, since I have some experience at the Fed, and there's always speculation that in a Trump 2 administration, he might choose to politicize the Fed. That's difficult to do in the sense that Fed appointments are not at the pleasure of the president. There are no vacancies on the Fed. Jay Powell's not going anywhere until May of 2026. Over time, as vacancies open up, a president can nominate folks to fill those vacancies. But monetary policy, even though we tend to focus on the chair, we talk about the Powell Fed. We didn't talk about the Clarida Fed or the Brainerd Fed or the Greenspan Fed. But the Fed is a committee, and importantly, interest rate decisions by statute are the outcome of a vote not only by the presidentially appointed governors, but also by the presidents of the Federal Reserve district banks, who are not political appointees. So it's difficult for a president to politicize the Fed, and if he wants to, it will take several years. But I should also say it's not impossible. In U.S. history, we have had periods where the White House has politicized the Fed. In the 1940s, under President Truman, in the 1960s, under President Johnson, and in the 1970s under President Nixon. What I can say is, although a lot of the criticism of President Trump and the Fed was focused on Jay Powell, he was asked once about the fact that he had nominated this guy, Rich Clarida, as his vice chair, and his answer was, I'm not very happy with him either. So,
so we know that the loser, as we often joke about, will be U.S. budget deficit, whichever party wins.
Yeah.
So, Rich, in the remaining of time, we wanted to wrap up with some investment implications, since you are also a member of PIMCO's investment committee. I think, as we know, right, on the public fixed income side, we have seen a generational reset into a higher yield regime where you could see high quality fixed incomes now yielding high single digits. So can you walk us through some of your outlook for the fixed income side?
Yes, and indeed, I wanted to emphasize a little bit the theme of this year's secular forum and essay is that investors should seize the yield advantage. So we went through a decade before the pandemic when there was a lot of discussion that rates were low or negative in some places. Secular stagnation was the macro theme. And so anybody who wanted a rate of return had to really reach for yield by moving out the risk spectrum or moving up the volatility spectrum. What has happened in the last 3 years is, with central banks raising policy rates to reduce inflation, that's led to, as you mentioned correctly, Justin, a generational reset in bond yields. And so right now, just focusing on a U.S. investor or an investor who has U.S. Fixed income in his or her portfolio, right now it is straightforward to put together a fixed income portfolio with a current yield of around 6%, with some mix of treasuries, investment-grade corporate bonds, mortgage-backed securities, perhaps some private credit. And in an environment where inflation is running around 2.5%, so you can put up a portfolio with a 3.5% real yield, And there's also a portfolio which is probably has about a third of the volatility as an equity portfolio, but delivering what historically is considered an equity-like return of 3.5% or 4% real. In addition, there's room for interest rates to fall. We went through a period in many countries. Look, you had trillions of dollars of debt in the euro area that was at negative yields. And now we're in a situation where in a future downturn, whenever it does happen, bond yields can and will fall, and thus there's the potential for a capital gain on top of a very attractive coupon. So we do think we're in a period where valuations do matter, and that investors, instead of having to sort of hold their nose and accept a really, really low, or in some cases zero rate of return, can have a very, very healthy coupon with the upside capital appreciation. So we do think having a global opportunity set is important. It won't surprise you to hear that at PIMCO, our focus is on delivering alpha on top of our benchmarks, and we've been doing that for 50 years. And so it is a very exciting time.
Thank you, Rich. And with that, that concludes our fireside chat. I'll pass the stage back to Catherine.
Thank you, Justin.